thanks, Sam. This is Dave Dickinson. I'll start off, and Jared and I will be tag-teaming this presentation today. So do me a favor, everybody. Let's go into your packets. Let's look at the table of contents, letter A, right before page 1, and let's talk about what we're going to talk about today. And then I'm also going to talk about what we're going to talk about in the second companion webinar. By the way, at the very bottom of letter A, that page, the table of contents, you'll see a link, and I'm sure you've received some emails from Bakers Online about Part 2. This is truly 4 hours of training. We won't be duplicating things. There will be a little bit of overlap just to get us warmed up in the Part 2, but it's 4 hours. We're breaking that into 2 segments just because it's tough to hold your attention for 4 full hours and have you get away from work to do this webinar for 4 full hours. So what we're going to talk about today, some of the things that are going on in the industry with the Congress, the current events, lots and lots of things, and obviously the Bigger Waters Act is a large part of that. We'll be discussing some of those things today. A lot of that will be at the end of Part 2, in large part because not all of those things are in effect yet, so we'll come more to that later. We'll talk about kind of the big picture, risk management, and the objectives of this law. But Roman numeral 4 will get into the meat of this. What do you really have to do, and when do you have to do it? That's the tripwires. We'll talk about flood determination forms, instructions, the notice. That's probably, if you're going to sleep through anything, don't sleep there. That's the part you want to wake up on, the notice. That's the big liability on your back. And then probably one of the trickiest things in all 4 hours is the insurable value issue, and that's how we'll conclude today. I'm going to go ahead and just briefly talk about what we're going to discuss in Part 2 so you'll know, and we'll get into a lot of the details. So we're setting up a lot of the big picture and the regulatory requirements, and then we get into that tricky stuff like deductibles and multiple buildings and low-value buildings, and can you do abundance of caution, detached garages, subsequent liens, construction loans, content insurance, the grandfathering. We'll talk about private flood insurance, some changes in that area. And then Jared will spend a bulk of time in that second companion seminar on condominiums, residential condominiums to be specific. That's a very, very difficult topic that Jared will make as easy as possible. We'll talk about forced placement, where your borrowers don't purchase the flood insurance, and then we'll get into the monitoring part. How do you administer this to make sure that your borrowers get it right and maintain it? We'll talk about escrowing, letter of map changes, some secondary market things, and then we'll finish up the second hour, 2 hours, with the Bigger Waters Act that we haven't really covered, I guess, as we are going through this. So that's what's on the table for the next 4 hours at least. We'll just do 2 of those today. So we won't be covering those things that are in Part 2. So if you ask a question and Sam gives that to us, please don't be offended if we say, sorry, that's not in today's materials. We want to wait till we teach it. That's going to be on July 18th, and there's a link there on your screen for where you can find out more about that second half of this. So we'll tell you what, one more thing on letter A. You'll see a bullet that says if you see things in italics, we're taking that right from the horse's mouth, if you will. And that could be the regulation. It could be a memo. It could be a FEMA bulletin. It could be from the Bigger Waters Act. But I want you to understand that if you see things in italics, we're quoting from a source, and then we always tell you where that source is so that you can look it up further, more details if you need. So the other side of that is if you see things in non-italics, we're just making that stuff up. So anyway, stay tuned here. Let's go to page 1, and let's talk about some of the current events pretty quickly. The regulatory environment, I would say since Katrina and Rita hit in 2005, there has been an emphasis on flood. Congress basically said we're fed up. We're tired of bailing people out that are supposed to have flood insurance, and if you were on before this webinar started, you saw some scrolling screens, and there was some statistics about some of the central, southeast states and the northeast, and those were some of the lowest areas to have flood insurance. Obviously, we've had Sandy hit. We've had Katrina and Rita and others, and Congress said, enough. We've got this law out there. Regulators, you're not enforcing it, so start cracking some heads. And stuff started rolling downhill, and they started cracking heads. And you'll see here in a minute, we'll put up some civil money penalties, but you'll see the huge spike in civil money penalties that occurred after, well, actually you won't be able to see that because we don't go back 10 years, we just go back 5, but there was not a lot of civil money penalties being issued until '05, and probably '06, '07, '08, they really cranked up, and they've maintained a pretty high level. And I know that Andy Zavoina at Bankers Online has a flood page that he lists civil money penalties. I don't like scare tactics, but understand that there is a pretty big hammer, and the regulators can use that hammer and will. And so that's kind of the regulatory side of this. Let me get into what Congress is doing. We've got this Bigger Waters Act. They've been working on that since '05. And the questions of, is it hurricane flood or is it wind, and what are we going to do with this thing? That FEMA's broke, the National Flood Insurance Program is broke. I want to say that after Katrina and Rita hit in '05, they gave $21 billion to the FEMA to bail people out, and it was supposed to be a loan, and then they came back later and said, okay, we realize you can't even pay that back. So lots and lots of things going on in Bigger Waters Act. Most of that is going to be covered in Part 2, and we'll certainly get you the information on that, and a little bit in this webinar, again, a lot in the next one. So, okay, look at letter C with me here. There were some frequently asked questions that were issued, I want to say, in October of '09. I actually was part of helping getting those written back in '03. It took them 6 years from when I first knew about it to finally get those Q&As issued. And they did clarify some things. They proposed a ton of things. And then they said, but we still have 5 FAQs that we're really not sure about, so we want to get your input. Then they came back in 2011, and they said, okay, here's the answer to 3 of them, but we still have 2 that are proposed, and those have to do with forced placement. So we have a bunch of final answers, and again, they did a good job, I would say, especially when it comes to the condominium topic, but they still have left open some things. Jared and I, if you look at C3, we did a webinar. Jared, was that 2009, late 2009, I think.
2009, that's right. Yep.
Yeah. Maybe they came out in September. We did our webinar in October. But anyway, there's still a link there that if you want to digest those Q&As more, you can see that and go listen to that, buy that CD-ROM. Now, that would have 5 proposals. It's down to 3, or down to 2, so they answered 3 of those. A little bit of information would have changed, but the bulk of it there, we went through each FAQ and basically said, here's what they're trying to say, here's what you have to do. So there's that for you. If we go to letter D, let's talk about some of the guidance that has been issued. We're going to give you the FDIC link, but it's really the same for all the regulators. Look at D2, Mandatory Purchase of Flood Insurance Guidelines. By the way, February of 2013, they rescinded those. FEMA came out and said, we're going to pull that back. We still believe that it's good guidance. There's a few things that are going to be outdated or are starting to be outdated by the Bigger Waters Act, and that's really why they rescinded them. I want to kick them for doing that because, update your manual, people. That's what I want to tell FEMA. Just get on it and update it. They haven't made any announcement that they will be. They just rescinded their guidelines. And they were just that. They're guidelines. Now, there's a couple things in those mandatory purchase of flood insurance guidelines that I disagree with. One has to do with insurable value. The other one has to do with relying on a previous determination. And we're going to cover both those today. I still think they're good things for you to have at your fingertips to look at, to follow, but you need to know what's been outdated, what's been updated, what's been replaced. But you can, anyway, still get those from FEMA's. No, you can't get that from FEMA's website. Or, do you know, Jared, have you checked on that?
I haven't looked on that, but I agree with what you're saying. I mean, where else are you going to get guidance?
Right.
I mean, there's nothing else out there right now, and we've heard that the examiners are still using the stuff that's still relevant.
Right.
You've got to have somewhere to go.
Right. And here's the tough thing. I'm going to go back a little bit to letter A at the very top. This is not a regulation issued by your regulators, not the OCC, FDIC, the CFPB, the Federal Reserve. Congress gave FEMA the authority to interpret this law. Well, they're not bankers. And so they basically said, we really don't have the knowledge to tell bankers what to do when it comes to this, so they wrote some pretty vague stuff. The regulators didn't have the authority to write a regulation, so they don't. And so oftentimes you'll call your regulator and say, what do we do with this? And they say, why don't you call FEMA? So you call FEMA and they say, well, you're a banker. Why don't you call your regulator? And that's exactly the problem that occurs. Now let me throw another thing in there. We've got insurance agents, and a lot of them don't know these rules. They don't want to know these rules because there's not a cost incentive because they make